Thank you once again to everybody who's out there in the audience listening to us and joining us for What's Next for Tokens. My name's Grog. I am one of the CAs here at Connext, and I am sitting down today with Mason. Thank you for joining me today from TokenSoft. We're expecting Arjun from Connext to come in today. Unfortunately, Julian from Curve was unable to join us today. He got pulled away in an emergency, so hopefully everything works out there, and we will miss you. So without further ado, let's give it over to TokenSoft and or Mason, whomstever wants to speak on this first. Tell us a little bit about yourself, about your project, and yeah, let's give us a little up front.
Do you want the long version or the short version?
Well, we're still waiting for Arjun to join, so give us the long one.
Okay, I started in the crypto space in 2013, and when I first learned about Bitcoin and all that stuff, I didn't think it would work. And so I tried building a dollar-based blockchain because I thought it would fulfill the promises in the white paper. And I spent a year building that, and then I went to a company called BitGo. So there I helped get exchanges set up with sort of their architecture, and did some software development on different projects there, and also made the first Ethereum multi-sig web wallet while I was there. And that became basically the prototype for what we did there on Ethereum. And then started TokenSoft in 2017. There were a lot of projects trying to launch different coins. And either there was a lot of hacks going on, or they couldn't scale to the number of users that were trying to participate in these token sales, and so they were crashing, or they were sort of forgetting the compliance aspect of it. And there's a lot of rules to follow when launching a token, for better or worse. And so we started TokenSoft to help make it easier for companies to launch tokens, and basically give them one place where they could bring in their community members to purchase the token or do an airdrop. And so far we've helped projects like Avalanche, The Graph, Moonbeam. We've probably had over 100 customers by now launch tokens, and about $1 billion has been processed through our platform for the launch of these tokens. And so that's the long version of TokenSoft.
Very cool. All right, it looks like Arjun's come to join us, so I'll allow him to introduce himself and take it away on that.
Hey all, sorry for being late. This was definitely a bit my bad. Just did not realize how much time was left before this started.
Arjun, we
I'm
forgive
Arjun.
you.
Yeah, this is a bit of a bizarre situation. My clock actually froze at 5:55, and I was like, oh, I have 5 minutes for like 10 minutes. But anyway, I'm Arjun. I'm one of the founders of Connext. Connext is a protocol for sending tokens and messages across chains. What we're trying to do is solve this, some of the really awful things that have happened with bridges over the course of the past couple of years. We think it is actually possible to have secure cross-chain communication, and not just cross-chain, but cross-rollup. And we believe that the right way to do this is by outsourcing security to the canonical bridges. So basically the systems that everybody has already been relying on that are heavily battle tested, things like the optimistic rollup bridges, the Polygon POS bridge, the Gnosis chain AMB, other sorts of systems that when you utilize a chain, you're already kind of trusting. We are live and have been growing for the past month, and are starting to now see the first kind of cohort of natively cross-chain applications coming online. So that is applications that are interacting with funds and data across multiple chains at the same time. Those applications are doing some really, really cool things, including things like cross-chain DeFi, so lending and borrowing across chains, swapping tokens across chains, governance, so like voting and executing proposals from DAOs across chains, you know, and then of course one of the most critical ones, which is tokens. You know, taking tokens and making them natively cross-chain so they can be transferred between chains cheaply and without having to pay lots and lots of gas, like underlying fees or costs by bridging to Ethereum. So yeah, I'll pause there, but I'm sure we'll get really, really deeply into the tokens piece soon.
Oh, I mean, I'm more than happy for you just to go on. I didn't mention it earlier, but I'm getting sick. I'm in a lot of pain today. It takes a lot of effort right now for me to put on this voice. But again, thanks you guys for sitting down with us. For those who are joining us now or who didn't start till later, this is What's Next for Tokens. What's Next has been a Twitter Spaces we've been running for a little while now. We're just looking to highlight, the most innovative projects of Web3, allow them to get up here, have a bit of a platform to share their vision of what they're building. And of course, we hope that these talks can help inspire other people and other builders in the space with have a new wave of ideas for the next gen. So let's start off just with some simple stuff. So, and by simple, I mean, none of this is simple, but what do you guys consider to be the most challenging problems or limitations of projects when they're launching a token currently?
Yeah, happy to take that. I think one of the hardest problems right now, just because the space has gotten a lot bigger than it used to be, is ensuring the right people get into either these airdrops or the token sales early. And what's happened is, there's a lot of bots in the space. There's a lot of like Sybil attacks to sort of get these airdrops. And I think the biggest challenge is just making sure, like, when tokens are getting out there, they're being distributed or airdropped, that it's sort of a fair distribution, and that people are trying to get involved in these different projects that have tokens for the right reasons. And so I think that's sort of like the biggest challenge that's being solved. And I'm starting to see people sort of think a little bit more about that, like what kind of users do I actually want coming into my community, and do they even understand what my project does, and asking questions like that.
Yeah, absolutely. That's definitely a huge one. I think that's like probably the number one biggest problem that people have been struggling with in the space for, I mean, since the early ICO days, of like, how do you make sure that the people who get your tokens are the people who actually care about the project? And because like those are the people that are going to be contributing and incentivized to continue like working, and like you want to make sure that those people get rewarded because they're the people that are pushing the project forward. And then of course, like minimize the effect that Sybils and other kinds of like farmers could have on your airdrop, reducing the kind of taking away value from the people that are actually like contributing. I think one of the other big problems is more generally just how tokens actually, so not just how tokens are distributed, but basically like how they can be used seamlessly in this ecosystem. And this kind of exists within a certain chain environment, but also more broadly in a multi-chain environment. I think like tokens within this space get rehypothecated and basically wrapped into other assets so frequently that it can be extremely like opaque to users. So for example, unless you're an extreme DeFi degen, you probably don't understand what like Aave wrapped V tokens are of some long tail asset. And yet when you see like on Etherscan, there's an asset that you're holding, which has like 5 lowercase symbols before it, and then the actual token name, most people get extremely confused about like what to do with that. And I think that in the process of wrapping these assets in that way, you potentially compound the risks that as a user you're kind of exposed to. So as a user, you're like, okay, I'm holding USDC or some stablecoin, but really what you're holding is like some derivative of that stablecoin that may or may not actually be taking on a bunch of risk. And this problem is like massively compounded when you go across chain. So like you have now not just the risk of one or many DeFi protocols that you're interacting with, but then also the risk of like the bridge or perhaps bridges that were used to generate that asset on a different chain as well. And of course, I'm sure that people here are quite familiar with what happens when that goes wrong.
Yeah, it's funny. It's like you have the originating risk of the asset. So like if it's like make or die, then when you're holding DAI, it's the risk that it'll be a solvent protocol. And then with like USDC, and Tether, it's like the same thing. It's like you're sort of, when you hold their stable coins, you're making a bet that they are going to be solvent and well managed. And then you bridge it over. And so you get comfortable with that originating risk, and then you bridge it, and now it's the risk of the bridge. And if this thing gets bridged through 3 or 4 different bridges, like that's the compounding effect. I think that's kind of like interesting and exciting. So definitely good to do a lot of diligence and know what you're using and you know who's involved in these different projects.
Yeah, for sure. Yeah, there's a lot of like nightmare scenarios where you think you're holding an asset and then really that's just like something that has been wrapped a bunch of times, and at some point in that stack something breaks, and then now suddenly the thing that you're holding is not worth anything anymore. And that risk, of course, like compounds the further into like the further away from the kind of big blue chip assets and big blue chip protocols and stuff like that you go, the more likely you are to kind of be exposed to that risk. Yeah.
You know, I'm going to bring this up just because it came up a couple hours ago, and just kind of going back to the, you know, the comment for ensuring the right people get into airdrops or token sales and bots and symbols and things like that. Arjun, you raised a professional counterpoint to a popular crypto Twitter personality who will remain unnamed regarding public sale versus private sale. Or a public and private distribution of new tokens. Would you mind elaborating on that, just in the, you know, in the context of this discussion?
Yeah, I mean it's hard because it's like there are like limitations that make it so like this is one of the frustrations of like projects in this space and of people like of trying to build something in this space is like you have to kind of thread the needle between, you know, what is best for your organization from like a, you know, growth and survival perspective, then what versus what is best for the world from a decentralization and fairness perspective, versus the specific like legal or regulatory requirements you're subject to based on like where your organization is based or like the kinds of jurisdictions you're interacting with. And I think I think that between all of those things, you sort of end up, we are in an unfortunate world right now where like, because you're subject to all of these things all at once, you can't really optimize on any one of them. So I guess what Joe is referring to is like earlier today, I kind of just tweeted about, someone had tweeted about how like accredited investor laws are actually fine because like people would, otherwise tons and tons of people would be investing, like, you know, the top tier of projects would still be going to like institutional investors, and the only like projects that would then end up raising from the public would be lower tier projects, which would be more likely to be scams and more likely to actually result in downside for like retail investors. And so like, you know, by that definition, they are actually kind of protecting people from the risk of having to, of like only being exposed to these like long tail projects. And I think there's some truth to that like it is the case that, you know, as a high quality project, you want to bring on high quality investors that are going to be more informed about how to, like, they're going to have more predictable understanding of how to interact with your project, and they're going to be able to like help open doors in terms of their network. They're going to have a brand that's more established, so you can raise more funding perhaps later on. And like this is true in crypto as well. Even though there's the whole goal is to like decentralize, like there is a reason why tons and tons of people will like chase after airdrops of projects that have been invested into by like A16Z or Polychain or Paradigm, because those funds are effectively acting as like a filter, right? You know that if they got past those funds, that this is going to be a high enough quality project that it's worthwhile looking at. And without that kind of a filter, it's like hard to really tell. But the flip side of that, and this was the kind of point that I disagreed with, is that having this VC-oriented world where as a project you are kind of forced into only being able to raise from VCs does create this really negative situation where the power and wealth of that is generated by tokens within these systems ends up remaining concentrated in the hands of the people that already had that power and wealth. And like fundamentally, that's antithetical to this idea of decentralization. And so it's hard. It's a bit of a trade-off, right? Like you want to make sure that retail investors are protected, but at the same time, like I don't think requiring that a person has $1 million is a very fair way to decide who is or isn't a sophisticated investor. I think there are definitely other ways to do it.
I think the coolest thing I'm seeing in terms of getting like tokens into people's hands is what I like about the space is it's moving towards giving people different challenges to complete in order to get a reward, whether it's in tokens or whatever. And so I think one thing I really like about how everyone's thinking the space is, how can I get my community more familiar with my product by doing A, B, or C? And as a result, sometimes these are called like incentivized test nets, or they're different, like I don't know, they're named similarly.
Yep.
And I think those are the coolest things that I'm seeing right now in terms of you're going to get a token holder base that knows how the product works, has played around with it, and sort of believes in the project and the team. And I think that's one really cool thing that's sort of emerging.
Yeah, absolutely. Like the theoretical end state. So like the optimal kind of token distribution is eventually some situation where you can ensure that the token, you basically are able to quantify in a provably fair way and in an ungameable way who the people are who are most contributing and most likely to in the future continue contributing to the protocol. Because those are the people that should be incentivized most. And those are the people that should be the biggest stakeholders, right? Of course, that's a really hard thing to do. And then I think one of the things that makes it even more difficult is that it's a bit of a dark forest style problem. So like, for example, airdrops are now not a great way to distribute tokens. And in general, the space has sort of like widely started to agree on this, that like airdrops are no longer a great way to distribute tokens. But that doesn't mean that they were always a bad way to distribute tokens. In fact, Uniswap's airdrop was a great way to distribute tokens. Why? Because when Uniswap did their airdrop, their retroactive airdrop, no one had ever done it at that scale before. And so no one was expecting it. But now that the expectation has been built that people will be doing airdrops, it creates all sorts of like weird incentives in this ecosystem. And it basically results in this like pattern where people now try to game it. And the worry that I have is like we're moving towards things like the Connext contributor program is a good example of this, where we like try to find ways to reward people for contributing to Connext in different ways, and basically like learning about the ecosystem, finding ways to like promote it, things like that, and giving them points to which would eventually be submitted to the DAO to give tokens to the people that participated. And the idea was like the people that actually took the time and effort to do that can be better stewards of Connext in the future. But the problem is, once again, like it feels as though in the long run, as you have these kinds of programs be set up and become processes and become institutionalized, people will find ways to game them. And that's the challenge, is like capitalism is really good at gaming things and finding ways to extract value. And like you have to kind of, there's a bit of a constant battle to figure out how to counteract that force.
And I think there's a couple things there. So one is people sort of like gaming these airdrops, and I think definitely like making them Sybil resistant and bot proof has definitely become a big problem for our customers, and so that's one of the use cases we've been sort of like helping to solve. And another thing that we ran into was like these airdrops. I think I'm with you 100%. We're like giving people tokens for free is kind of it's not helpful to the network, because then like the people that have the most just dump, or people try to dump right away, and so you get like a lot of speculators trying to game the airdrops so they can do that. And one thing that we rolled out also is just vesting for airdrops, or that are either time-based or price-based. And basically, I think the goal with all of these different like layering of rules, you could say, is to ensure long-term thinkers are holding the token. And so vesting is a great way to do that, because if someone thinks that they're going to be able to, I don't know, create sort of an army of bots, get a bunch of tokens, and then sell them right away, well, now if there's Sybil resistance up front and there is vesting on the token, it's that sort of modeling is more aligned with long-term thinkers. So you're sort of going to repel short-term thinkers and bring in long-term thinkers that are willing to wait that 6 months for the vesting, or 1 month, whatever it might be. So I think there's a lot of cool mechanisms that will emerge to be more common in the coming months and years. And it's just like experimentation. It's like Uniswap took that first step to the retroactive at a large scale, and a lot of other people are experimenting with airdrops in different ways, and we're going to be able to learn more and more along the way. And that's, I think, one of the cool things about crypto being so open and public is we can learn faster and innovate faster as well.
Absolutely. And you're seeing that. Like, one of the models I really like, and I think this is something that I would love for, I mean, it'll of course be up to the DAO and stuff like that in the future, but like, I would love for Connext to head in this direction, is what Optimism is doing with having like multiple airdrops. So like basically continuously releasing tokens and like iterating based on previous experiences of doing airdrops to try to hone in on the specific people that are the like highest value contributors, the highest like most committed people within the ecosystem. Because I basically like, and you can do that better when you don't have like one singular big event where people are being airdrop tokens, and instead you have like a continuous mechanism of like funding contributors.
Yeah, they want the holders that are the most optimistic about the project, right?
Yeah.
Ouch.
Yeah, absolutely.
So I'm gonna kind of skirt around a lot of the questions and stuff I have about stables, unless you guys do want to chime in about stable coins. What are like the legal risks or like the limitations that we'd see with these kind of airdrop systems and projects for token distribution?
Yeah. Yeah, I mean, it's challenging. This is of course like subject to, different jurisdictions and different projects. One of the big challenges that exists is that it's actually, in many cases, it's actually difficult for the project to even be able to talk about the specific legal like circumstances that they're dealing with, because by simply talking about them, that actually increases the legal risk.
Oh, sorry.
No, I mean, I think I'm sort of like talking more in higher level terms, and this is true, not like, this is just generally true in many jurisdictions around the world, where like in instances like, so maybe I guess taking a step back, and I guess Mason, you probably have like a better context around this, but at this stage, there are very few places in the world that actually have very like clear legal frameworks for issuing tokens. And the problem with that is that when it's unclear, you sort of have to figure it out based on, case precedents, based on like hearsay, based on, interpretation of something that was like written about 30 years ago. And because of that, you have to kind of like be very careful about what you do and can't do, or say and can't say, because like, anything that like, it's extremely unclear. And like one thing that I've noticed is that there's, and this is true again in a lot of jurisdictions, when you have these kinds of like unclear regulations, it actually becomes detrimental to decentralization. You end up in the situation where like you get into these like catch-22 situations where like you want to actually have a very widespread token distribution. You want to have a very decentralized network, but the way that the laws are structured make it difficult to do that, because you're not able to have as much transparency as you would like to. You're not able to, like have to be able to like launch a token in the way that would actually be most fair. So I think this is just like a broader challenge around where regulations are, where like there hasn't been enough time for there to be like more clarity. And until that happens, everything is always going to be a bit murky, and people's plans will have to continue shifting as they assimilate new information. I guess, Mason, maybe you can expand on that.
It would be my pleasure. So I think here's the problem with the space is we're all developers. And because we're in the blockchain space, it's like when we start companies or launch products, um, these happen to be things that are highly regulated. And so the problem is, as developers, we're forced to understand legal stuff and figure out how it works really quickly. And we see a lot of teams out there, not ones that work with us, but they basically just block the US and do whatever they want. And it's one strategy. I think it's really hard as developers for us to know what's right or wrong. You know, we're not legally trained, and even then, we're not legally trained in the very specific vertical that these tokens exist, which is the land of securities and banking regulations with like KYC AML stuff. And so my advice to like projects out there is, you know, a lot of people go out there and they talk to a lot of founders and they say, hey, what should I be worrying about with respect to legal stuff? And the problem is that these founders all have different law firms, and different law firms basically guide their projects very differently because they have their own perspective on the regulations, and they have their own structures that they like, where, you know, if the SEC comes later or a regulator comes later, they feel like they have they can defend those structures. And so the problem with getting advice from different founders is you hear a million different things and it can be kind of debilitating and you get kind of stuck. So I always recommend just find a law firm that has worked with a bunch of projects in the space already and has a structure that they really like, that they use over and over again, and use that law firm as your like source of truth. And that way, you know they have confidence in what they're doing, and they've done it before. And then the projects have a little bit of clarity because there's like a single source of truth with respect to what you can do, what you can do, what you shouldn't do. And I think it's just a lot more of a healthy mindset for an entrepreneur to build in.
Thought I might have been talking over you. So obviously, like Arjun mentioned, there's been a lot of, I guess, evolution as, precedence is set and certain legal disputes are settled, or things that are sent to the SEC or ruled upon for better or worse. How else have token launches kind of evolved? Because I'm assuming things were a lot more, loosey-goosey like 4 or 5 years ago than they are nowadays. How do token launches kind of compare relatively for the last year or two versus, the early days of crypto?
Yeah, and Arjun, feel free to take over. But I feel so. We started helping tokens launch in 2017, and that was like really early. That's after you saw like the Gnosis launch, and after the Tezos, which we ended up working with later. And I think if you look back at the landscape early on, there was a lot of people that thought all you had to have was a white paper to launch a token. And a lot of people didn't realize the white paper is actually a technical spec. And so it was very like, this is my brand and this is what I'm going to build and give me money. And I think the problem with that is like the barrier to entry for that is just so low, right? And so when barrier to entry is low, then quality goes down and scale goes up. And so we saw a lot of projects, but the quality was low, and they were getting to market quickly. And so you get to like 2020 with DeFi Summer, and the cool thing about DeFi Summer was people were actually starting with the products. They would put different products out there like Uniswap, Compound, and there's people that are now leading with the project, basically doing the down payment of doing the development work, hopefully getting audits. We don't know for sure. And then launching the products. And so these different projects are now looking at launching tokens. And so what you have with projects that are doing airdrops now or launching tokens, however they manifest, is that the project is already built, and usually they're already on testnet or they're already launched on mainnet. And I think that's like the super cool thing about the space is we went from little substance and fundraising to a lot more substance, and fundraising is a bonus. And so it's become a much more higher quality space. There's better teams, there's better projects, and there's actually people building. And I think that's the coolest part about where we are today.
Yeah, for sure. Yeah, we started Connext like I think shortly after the Gnosis ICO, I believe. Because I remember like the Gnosis and Augur ICOs were like instrumental in helping, like, so the earliest iteration of Connext didn't last very long. Was to allow people to be able to buy tokens with credit cards. And then that kind of came about because we saw some of the challenges that people were having with being able to participate in ICOs. But we pretty quickly realized just like how challenging that is to do from a legal perspective, and also that the space was like nowhere near ready for that level of adoption. It was like we were just seeing tons and tons of issues with like scalability. But yeah, generally, like I really agree. Like I think it's awesome to see that like the level of quality in the space has improved really massively. I think that like there has been an overall shift. Obviously, like back then most of these projects were launching ICOs, so doing public sales. Now public sales are actually a little bit more rare. You'll have things like LDPs, and then you'll have like some kinds of public sales that go through stuff like TokenSoft. But it's not, in the past it was like 100% of projects, and now it's a much smaller percentage. And I think one of the things that has also changed there is that the way that ICOs used to happen was also, it's like in some cases it was fair, it was more fair. So cases like Ethereum were actually quite decentralized and quite successful, but that's just because they were early. And this is maybe gets back to what I was saying earlier, where there's like this thing where like once you have a project do something and then that strategy achieves success and returns money for a bunch of people, then everyone will start looking for that pattern everywhere else, and then start like you just end up like people end up optimizing on it. And so like because the Ethereum ICO was such a success, people started then trying to game other ICOs. And so I remember like in a lot of the early ICO days, like there were some fair examples of ICOs, but then there was also a bunch of ICOs where like you had the ICO start, and then within the first like half second, like someone would come and buy 80% of the tokens or something like that. And there was like nothing, and like people just didn't know that, oh, okay, we need to set caps and we need to do verification and things like that. And now I think there's been a large shift away from that and more towards like raising private funding. I think a lot of that has been driven by the regulatory climate. So like it's become a lot harder to do public sales in general, especially in the US. And I think like as a result of that, more and more people have moved towards like, okay, we're a small company, we're a small project, we don't have the level of funding to be able to like actually jump through all the regulatory hoops to do a public sale. Let's instead focus on, let's just go to a VC and raise from them first, and then like figure this problem out later. And I think it's like, it kind of, again, it's like, it's good and it's bad. It's good because there's a lot less scammy projects. It's bad because like the VCs sort of filter that out, but it's bad because, it's not really great for the ecosystem when you have like projects get to like multiple $1 billion in valuation in the private market, and then like do their token launch afterwards, because at that point there's really no upside for users, for end users.
Fun fact, TokenSoft can help projects do public sales in the US.
Yeah, talk to TokenSoft if you're planning to do a token sale. Yeah, it's kind of, I mean, I'm kind of curious to see where this stuff goes in the future. It's my guess is we're going to have like a broader separation of the funding mechanism. So in the past, it was like funding and distribution were the same thing through an ICO. I think over the course of the next few years, my guess is we're just going to see better and better separation between funding and then distribution. I think I would love to move away from a model where funding is only coming from VCs. And I don't have an issue. I mean, we have amazing investors. I think there are plenty of incredible VCs in the space that help a lot and that are very, very like smart and actually have made a huge impact on pushing the space forward. But I think that like one of the problems that exists is that the VC model does actually push this ecosystem towards like hyper competition. So, why, for example, are there like 50 different bridge projects? Like, there are still new bridge projects launching today. Why are there so many different bridge projects? Well, it's because the marginal cost as a VC of like funding yet another bridge project and pushing them towards doing a token launch is so much lower compared to the potential return on that token that like it's better to seed a competitor than it is to try to like back something that's already like high quality. And that's a problem, right? Like, it's good in the sense that it creates a more competitive ecosystem, but it's bad in the sense that it like completely stops cooperation and it leads to like the fragmentation that we have today.
I think when you're thinking, going off what you're saying, like when you're thinking of like who the token holders are, it's like in 2017 people were paying with money to get the token, and so it was like pure investors. And I think it's sort of like changed where like when you do sort of an incentivized testnet and airdrop combination, it's like they are paying by learning your product, and they're basically putting in work and effort for a reward. And then investors are sort of like a different class where like maybe they put in more capital, but they also put in effort by giving guidance and helping like architects, what a launch should look like or how to get to market and stuff like that. So I think it's kind of interesting. I think it's going to like move towards a diversity of different people having access to the network by putting in different types of effort, whether it's money or actual work or just learning something. And hopefully like we discover more and more new ways that people can participate, and maybe put in effort or work in different ways.
Yeah, for sure. I think if we could come to a world where there's like a meaningful low effort mechanism to do to have like be able to like raise from a widely distributed audience, so effectively like a public sale, to be able to have a widely distributed ecosystem of contributors that are also earning tokens, so that people that are again working and using their work and their effort and their like participating in the project in other ways to like become stakeholders. And then lastly, having some sort of objective mechanism for basically figuring out which projects are the high quality projects in the first place. If you have all of those three things, then I think we could actually push towards an ecosystem that is just far, far more fair.
What's interesting is like we're really focused on like the inception of the token and getting it distributed out there. And when you think of like the on an ongoing basis, what's like the most valuable to a DeFi protocol or to something like Bitcoin? And what's most valuable is actually probably developers continuing to develop on it and bringing new ideas and new innovations to make the tech better. Because when the tech is better, now there's more use cases. Like we're seeing with Bitcoin, now ordinals are possible. And before it was literally just peer-to-peer payments and multi-sig wallets. And now we have NFTs on Bitcoin essentially. And I think what's going to be interesting is, how do we as in the blockchain space continue to incentivize that building on an ongoing basis? Because I think that's the lifeblood of these different projects is, are they continue to innovate and continue to build new things to create more use cases for the products?
Yeah, for sure. I'm excited to kind of see better token use cases too. Like, right now, so much of the tokens are like, I'll be honest, in my opinion, almost 100% of the space is driven by speculation at the moment. We don't yet have like very material use cases for people that are, consistent day-to-day use cases that people like normal people can use that are not speculation driven. There's like a few, but it's actually quite minimal. I think we will get there. I think a big part of it is just, getting to the point where the infrastructure can support more generalized applications that can do other sorts of things beyond just like 200 lines of financial code. But like, until we get there, I think we need to start thinking about ways to move away from speculation being the only kind of driver of what makes tokens interesting. Like I'm really interested in this bear market to see what projects are like experimenting with new kinds of token models that are not just, I mean, obviously governance tokens are, they're like not just on their own going to be enough long term. Like the governance token is sort of like a bridge towards eventually figuring out better mechanisms. But I think like we need to accelerate the rate at which we find those. Like I think, for example, like the V token model that Curve has, and that, I mean, I guess was pioneered around Curve, and then now everybody is adopting, is amazing, because basically what that's doing is taking something that was already happening within governance, which was figuring out where token emissions should go, and protocolizing it in a way where now it's automated. Now there's no need for that like external governance decision making. Now it's no longer gameable through like just buying votes, but instead it is actually becoming a core part of how the system works. And I think over time we will discover more things where people will be like, okay, I'm noticing this one use case in governance happening constantly. Let's just turn that into a like something that happens in the protocol.
Wow. Just wind you up and watch you guys go. You covered a lot of stuff that I already had lining up here. So now I got to find a place, another jumping off point. So, okay. So like you guys are talking about the future, you know, like what use cases are going to emerge, what we're seeing as far as, you know, some evolutions in the space, and the V model's already been covered. So what other portion, like what other token types, or like we're going to see cross-chain tokens are starting to come out here, and obviously that's a big deal with Connext as well. We're seeing the emergence of new stable coins. What does the next generation of tokens look like to you guys?
Go ahead.
I think if we look back really early on, like the first iteration of this, I guess the first iteration was Bitcoin, but Bitcoin sort of has like a use case where you pay fees in the underlying token to use the network, and you're basically paying for like the security and the peer-to-peerness and being able to send money anywhere. At least that's how I see it. And then with ERC20 tokens, the problem was it was too easy to make a token, and then what is it for? So in 2017 we had a lot of projects launching tokens, and they were associated with the project by brand, and not really any more than that. And then the next generation was governance tokens. Okay, let's use the tokens to vote. And I think the problem with that is that, like, why did this take off? It took off because it like checks a regulatory checkbox for lawyers, but you know, is it enough to just vote on you know, what the protocol should do? And so I'm hoping that like the next generation of tokens builds more use cases beyond governance. And you know, there's a lot of creative people in the space, so I know that we will figure it out. But you know, what are some other things that these tokens do? So governance is kind of a boring use case. So is there anything in the application, like maybe you have to lock up tokens to be able to use a certain feature in the application? Maybe you have to lock up tokens to, I don't know, maybe you can only put 100K into a pool, but if you lock up enough tokens, now you get access to being able to put more assets into the pool. So I think like using tokens to unlock different use cases, I think is going to be a huge thing moving forward. And I think the thing is, like, we just have to get the whole space comfortable with actually being creative with that, because a lot of people in the space, a lot of the teams say, okay, we have a governance token, that's it. But we should be asking ourselves, okay, we have a governance token, and now what more can we have this token do? What other use cases are now possible if you have this token? And I think that's how we build real value into these different token economies.
Yeah, the nice thing is the slow march, or I guess in this case, fast march of capitalism will force teams to do that, right? Like the teams that don't find use cases for their governance tokens will eventually have those tokens be dumped, because people will be like, well, why am I holding this? Versus something where it's like, oh, there is a legitimate need for this token to now be used in this ecosystem to do XYZ, whether that is vote escrowing for some specific kind of thing, or it's other kinds of more interesting things that can happen. And I think like what we're going to start seeing is like something that I've noticed is like basically every idea that happens in the space is actually something that was thought of and talked about a bunch of years ago and then was recycled. And then it's just that like it was talked about a bunch of years ago before a market existed for it and before the space was ready. And now, as a result of being much further along, I think we'll we can then take those older ideas, map them to what exists today, and those things can actually like be powerful and useful and valuable. So I'm waiting for like the return of a lot of the OG token narratives that I legitimately still think are quite valuable, like curation markets, for example. Like there is absolutely a use case for tokens to curate which kinds of things in a product are actually valuable, right? You can use your tokens to perhaps vote escrow those tokens or use some other kinds of mechanisms to signal which Oracle data a Oracle network should actually be like a fully permissionless Oracle network should actually be paying attention to signal like what what rollup messages need to actually be attested on a data availability layer, to signal like which subgraphs need to be prioritized from graph network indexers, like those kinds of things. I think separately from that, so there's kind of that whole bucket of things. So like I think we'll find a lot of those use cases now over the course of the next year or so. I think separately from that, we're also going to Joe, you mentioned multi-chain tokens and cross-chain tokens, and I think that that's really a big one. Like, I think we need to move towards a world where like two things are true. One, tokens are available on all the chains associated with that ecosystem, and I think most projects are going to exist on many chains because it's at the very least they'll want to accept users from many chains because otherwise they're just unnecessarily self-limiting. And as a part of that, as a part of operating their governance or operating how the token works, they will most likely also need their token to exist on multiple chains. And I think that there are ways to make that seamless, like that through Connext, you can make tokens natively transferable across chains so that they can be sent through Connext with no fees, or at least no slippage, and be utilized on every chain, minted to every chain that Connext is connected to. And I think most other bridge projects also have something similar. But then even going a step beyond that and reducing the asset fragmentation. So working towards a model where a token that does have that is actually able to be minted by the Optimism bridge, by Connext, by potentially other bridges that the token issuer is actually comfortable with, and with like risk controls and things like that to make sure that nothing goes wrong. So making sure that like the experience of tokens is great.
Hey, Arjun, I have a question.
Yeah, what's up?
So one thing I run into a lot, because we see a lot of projects launching tokens, is when projects launch, they're like natively multi-chain, and that brings up the question of which chain do I launch my token on?
Yeah.
And so it's like, do I originate it on ETH and bridge it over, or do I, if I have 10 chains, do I do like 100 mil supply on each chain? But then like when they bridge, like how does that happen? Is that something like Connext can solve or has a sort of a path for?
Yeah, we actually have a like fully fleshed out specification for how to do this. We're thinking about doing it for our own token launch eventually. We haven't yet decided because we don't know yet whether or not it's something that we like want to prioritize or not. Just because we, of course, we want to make sure that the token gets out as quickly as possible. But at the same time, the spec that we have in our hands right now is actually very straightforward to build. We don't think that it would take very long, and so we're thinking about it. But basically, the way that this would work is you would allow for users to be able to claim tokens from an airdrop from any chain. So say we're taking Next tokens as an example. And again, I'm not at this stage committing to us doing this because there are like liquidity concerns and things like that we have to think about as part of this. But how this could work is users would go to like the Connext airdrop page. They would click claim tokens. The UI would ask them which chain they want to claim tokens on. They would switch to that chain in MetaMask, and then they would just claim tokens and they would get the tokens on that chain. All of the airdrop calculations and stuff could be hosted in a contract sitting on one chain, but the user actually gets their tokens minted to any other chain. And then those tokens are by default already natively deployed through Connext. So that means that now those tokens can then be sent to any other chain with very minimal fees. So to answer your question, I think like in my opinion, I think this whole question of like which chain should I launch on should go away. Like we have asked that question ourselves last year when we were planning to do like the first time around we were trying to do the token launch and we had to delay. That was one of the big questions we were asking ourselves was like ETH gas prices are incredibly high. We want to make it cheap and easy for people to claim their tokens, but we don't want to end up locking our ecosystem into only one chain or only one rollup. Yeah,
Exactly.
And this is the solution, right? It's the notion of which chain am I deploying on should go away. It should just be, yes, I'm just everywhere.
I have a question. How do you guys maintain like that state cross chain, like what the supply should be, and basically not having it duplicated? How are you guys thinking about that?
Yeah. So there's a couple of different options for this. And this is just sort of more generally the theory of how these tokens work. There's two different ways to do it. Either you have one kind of primary chain where that state is maintained. And that chain is like the source of truth. And that chain has the max supply of the token.
Oh, well, that was unfortunate. I think we may have lost Arjun all of a sudden there. Or he dropped out of his speaker role anyhow.
I thought
Let's give that a moment.
Oh, he's back though.
Fun.
And then every other chain, you just mint tokens against that primary chain. So you sort of like have like some portion of the supply be minted on other chains. And you can always check the invariant that the amount on the primary chain is greater than or equal to the amount, the total amount minted on other chains. One way to say this is that it's a lock and mint token. So like, I'm talking about the abstract concept here, but the basic concept here is like, this is just how like lock and mint tokens work and like how wrapped asset bridges work. Is like you have a single chain where the assets are locked that has the max supply, and then you mint everything against that, and you can always check that invariant. The other option is a burn and mint token, where you don't have any single chain with the max supply. You just always know that the invariant of if I reduce supply by X here, then it must go up by X in another place is true.
That's what I was going to ask, because like in the lock and mint, I think the issue you run into there is like you have like if you're going to move 100 mil tokens from one chain to another chain and you're doing the lock and mint, now you have 200 mil tokens, and so the supply is duplicated. So does the price, should the price go down? Like it brings up all these questions, but when you burn and mint, that sounds like the most logical way to do it, because then your aggregate supply is always fixed.
So,
and that never changes.
A lot of people think that, and it can be tempting to kind of, so like when you really get down to the brass tacks of these things, they're actually the same thing. It's really just a data structure, right? And so, it's like, it's incorrect to say that your total supply is changing, because you're basically putting the tokens into a place where they can't actually be utilized. And like, it's sort of like saying, okay, has the total supply of Ethereum, of ETH, changed because wrapped Ethereum exists? No, obviously not. And because you don't count the sum of the total possible supply of, like, you don't count the locked ETH in the wrapped ETH, like the ETH wrapping contract, as part of the ETH supply, in addition to the wrapped ETH that is wrapped, like the wrapped ETH token. And I think like fundamentally, the difference between these two data models is just like, what are you setting as the address for the token in the token contract when that token is bridged? If you set it to some fixed address, then it's locked. If you set it to the 0 address, then it's burned. Fundamentally, from a data structure standpoint, it's actually the exact same thing, which is quite interesting.
Are there any are there any major differences in like trust assumptions between a burn and mint and a lock and mint?
No, and I think this is one of the things that there was a hot sec where people tried to push this narrative that burn and mint tokens are more secure, but like they're not. It's like fundamentally the exact same thing. It's just like the real security comes from the underlying messaging infrastructure and the underlying system that has the authority to mint tokens. Because the reality is, in a burn and mint system, like in a lock and mint system, sure, you could compromise the system, unlock the tokens, and then now you're left holding a bunch of unbacked tokens. But by the same logic, in a burn and mint system, you can go and mint an arbitrary number of tokens. Those could then be sold, and now you're holding a bunch of unbacked tokens. So like fundamentally, that ends up being the same kind of equation.
The lock and mint is just really bad for my OCD. And it just messes with my head.
The nice thing about the lock and mint is that it's a lot easier to monitor. So in the burn and mint model, you are having to monitor token balances across multiple chains. If you want to, so for example, if like Connext right now has like watchers in our network that automatically pause the whole system in case they detect that a hack has occurred or anything has gone wrong, really. And one of the things that they check for is the invariant that the amount of tokens locked in the system on Ethereum needs to be greater than or equal to the amount of tokens minted throughout the rest of the system. That is way easier to check in a lock and mint system than in a burn and mint system, because in a burn and mint system, you're kind of sending calls to RPCs on different chains. You're receiving data back at different times. It's kind of a little bit harder to like piece to get like a holistic view of what the total supply is at any given time. But yeah, it can be kind of annoying from an OCD perspective, for sure.
That's interesting. Is there any risk for, like, let's say the lock happens and the mint happens, but then there's a reorg that pushes out the lock or undoes it? Is that a thing? Is that like what happens in that mechanism?
And this exists in burn and mint too. But basically, like again, all of the trust, so like the token infrastructure is really just like a layer on top of the message bridging infrastructure, right? And ultimately, the token infrastructure is just a data structure. It's just like a storage of address to amount that you're updating using some logic. And that logic is entirely secured by the underlying messaging infrastructure. So it is really the job of the messaging infrastructure to protect against reorgs. Like our underlying messaging stuff, our underlying messaging stuff works a little bit differently because we actually pass messages through the canonical bridges, but the canonical bridges do actually check for reorgs on every chain. You don't really need to do that on the rollups, but they do for the other chains. And that's kind of like an important part of making sure that otherwise you send a message for something that never actually happened. And that is obviously hugely problematic in any case.
Yes, exactly.
Yeah.
That's super interesting.
We do like reorg protection in other places in the network. So for example, like in Connext, like there's an underlying messaging infrastructure, which, like I said, uses the canonical bridges. But then, as a user, you don't necessarily want to wait for a message to pass through like the Polygon POS bridge to Ethereum and from there to like Optimism. That just takes time and costs money. We do it in batches, but it still takes a lot of time. So Connext basically has what is called an execution layer that sits on top of everything, a fast execution layer specifically. And what that involves is there's a bunch of like actors within that system who just front liquidity or maybe execute the call immediately on the destination chain, and then they're repaid by the protocol. They're safe to do that because they know that there is a transfer coming through the protocol that will repay them. But they're only safe to do that if they know that that transfer is not going to get reorged. So like if you're a router in Connext and you're fronting liquidity to a user to like execute a transfer or Uniswap swap or whatever on the destination chain, then as a router, routers check for reorgs. Routers will they'll see the transaction got started on Polygon. And on Polygon specifically, for example, we wait I think 2.5 minutes.
Okay, super interesting.
All right. Well, we're starting to get close to the top of the, well, we're past the top of the hour, but at this point, I know we started a little late, so I've been letting things go on, but we are starting to get near the end of it here. I'm going to give you guys a couple minutes here to, give some end comments, tell us about what you got going on, what you got coming up for Q2, any final comments or thoughts, because this has just been mind expanding, at least from my perspective. So we'll start off with Mason. I'll give you some time just to talk about what you got coming up.
Cool. At TokenSoft, we obviously do token sales, and we launched TokenSoft trading in beta. And so if you'd like to help test that out, please, I guess, go on our Twitter accounts, and I'm sure there's a link for TokenSoft trading. And then we'll be launching a few more tools. We launched a tool for distribution. So if you're looking at doing a distribution with time locks or price locks, so if you want to use do tokens that unlock when Bitcoin hits 70K, 80K. We launched some tooling for that everyone's welcome to use, and we'll be announcing some more stuff as we go. So if you're looking at launching a token and you're just worried about, how am I going to prevent Sybil attacks, or how am I going to make sure everything's distributed, feel free to reach out or DM, and I'm always happy to help talk through it. And I just appreciate you guys having me on today.
When cross-chain token launches on TokenSoft, Nathan?
Actually, we are. It's not as sophisticated as what Connext can do, so I really want to see if we can integrate what you guys have. But right now, we do have token distributions on 6 chains.
That's awesome.
We haven't. Yeah, you guys solve a big problem that we run into, where it's like these people want to allow people to claim on any chain. So I'd love to chat more and see, how we can make that a bigger concept.
Awesome. Yeah, I would love to do that. Cool. I mean, on the Connext side, we've been up and running for the last month with our MROC network upgrade. As you guys probably heard on this call, there's a lot of really cool use cases, including things like cross-chain airdrops that become possible now that this is live. And so if you're a developer that's building in the space, intrigued about how to build your application in this really interesting multi-chain environment, how to be able to onboard users from any chain, or to be able to access liquidity from any chain, or to be able to do other kinds of more sophisticated things, reach out to us. We have a awesome group of people helping support the community within our Discord. We also have people available on the labs team to help with support on technical integrations. We just want to help. And then, aside from that, I think thank you so much for Joe for hosting. This is an awesome set of questions, and they're really good chat.
I honestly, once again, feel like I barely did anything. You guys keep everything flowing, everything's lubricated. I'm just here to prod you once in a while. So once again, though, I will say a huge thanks to, obviously, both of our speakers. You guys were fantastic. Thank you very much for sitting down with us today. Thanks to all our listeners for coming out and joining us. If you guys aren't following either Arjun or Mason on Twitter, you really should be. For all the big brain takes, you guys are 100% missing out if you haven't been following them this entire time. If you want to recap or you're joining us late, we will be posting a thread with a recap of this later on. And I do want to remind everybody here that Connext is still running our LP campaign, and we'll have that posted up here very shortly. Oh, there we go. Where top 30% of all our LP stakers are going to be getting a very special NFT commemorating their participation in the launch for our new, basically our latest iteration of the system. All right. Well, thank you very much, everybody. And I hope you have a fantastic, it's only Thursday, but it's Thursday. So we're almost there.
Thank you, Grar.
Awesome.
You said it perfectly.
Thanks so much. Bye.